I think the pandemic has given rise and made everybody feel much more open to some of the issues that we have been discussing in sustainability for a while. So there are some of the undesirable effects, obviously, the health impacts, even the unintended positive consequences, like the reduction in CO2 emissions from the loss of trading activity and consumption and business activity. But I think it has also and mainly created a sense of vulnerability, of a need to look at the system in a different way, to see the path that we've been taking, how resilient that is for businesses, for the economy, for communities, and for societies. And I think at the center of that, it has created a need to revisit the S in the ESG, particularly as we think about social issues. And while inequality as an issue has been growing in significance over the last couple of years, with the rising gap between the rich and the poor around the world, within countries too, I think that the pandemic has made us really take a step back and look at how resilient, how vulnerable, how strong are we? What do we value in society? What is our purpose? And to put it sort of more grandly, there are conversations everywhere about the role of communities, about the value of work and which jobs and which functions in society should be paid more or less. So all those questions that have been bubbling for a while, the pandemic has come and kind of made them, put them right front and center. And the other benefit from all this crisis has been that we have seen that we can intervene very radically. We as governments have kind of come together or on their own, have made transformative changes to the economy to deal with what we perceive as public crisis and public issues. So this notion that it's unaffordable, or we have to, there are various constraints that we like to put on not investing or not taking radical actions or not changing things. That all seems to have been demystified through the response that we have put in the pandemic. So with all this crisis and the loss of health, we are at least in a position to revisit some of the core foundations of the economy, society, and business.
That's sort of the sense that I often got when speaking to some CEOs on Zoom, which we try to do as often as possible. Huub, I'd like to go to you now and ask you, sort of from your perspective as a large multinational business, do you get a sense that the S in ESG is now getting more attention than the E? There was clearly a sense, even in Davos earlier this year, the environment was really rising up the corporate agenda. Sort of ESG almost became a byword. It was basically the E that mattered in ESG, and now the S is becoming much more prominent. But on the other hand, there is possibly a trade-off when you are a company, or a nation for that matter, but specifically a company with limited resources, as all companies are. A dollar you spent on better wages or supporting the community is a dollar less spent on decarbonizing. So there is a trade-off there. Do you see that trade-off being more visible at PMI? And if so, how are you trying to approach it?
Well, all companies should start with a sort of a materiality analysis to see where can you as a company make the biggest impact and where do you cause the largest externalities. And indeed, many people equate sustainability with environmental matters predominantly. But if you look at it, take our company, we are a tobacco company. The biggest impact we have uh, is on the health of the consumer. So actually, the ESG discussion is actually missing the P of product, I think, sometimes. And in my strong conviction, I think if you don't look at your most material topics and address them head on, I don't think you can call yourself sustainable as a company. So in our case, the focus has been very much on what can we do about the product that we produce and sell, and the impact on the consumer. And the conclusion is very clear. We must replace cigarettes with something better. And this is the line we have been on for the last 4 years. And we think that many countries can be without cigarettes within 10 to 15 years. So that's my short answer. If you look more broader at ESG, I think many companies, including ourselves, between the E and the S has far bigger impacts. I mean, in our case, it's predominantly the farmers who are producing tobacco and labor issues, especially in developing countries, which are, I would say, the major focus we have when it comes to sustainability. Not that we are ignoring climate change, but climate change is, of course, the #1 material topic for the planet. And we are, I think, very good in that respect. But as a tobacco company, you can be the greenest company on the planet. If you don't do something about the product, I don't think you can call yourself sustainable.
So can I just do a follow-up question on that? You mentioned materiality. How does PMI, do you have a sort of a specific algorithm for determining what in your business is, does have material externalities, positive or negative? Yeah. And so yeah. How do you analyze materiality? I think that might be very interesting for other firms.
Yeah, yeah. Look, we first look at, based, of course, we have a lot of stakeholders who provide us feedback continuously, from, let's say, tobacco control groups to more, Human Rights Watch, other organizations. So the first thing is to look at what do people say and think about the main impacts of the company. So we had a long list of about 26 topics, which are among the most material topics according to stakeholders and according to our own perspective. And actually, it's interesting to see that the internal feedback and the external feedback was more or less exactly aligned. And then for each of those 26 topics, we did together with some external help, sort of a desktop analysis at looking at, where is the impact is it in our company, is it in the supply chain, is it with the consumer? So we looked at where can we make the biggest impact, basically. So we haven't gone as far as trying to measure the impact in a monetary terms for each of the topics, but we did go through a formal analysis to say, where do we have the biggest impacts on the SDGs, and where can we as a company make the biggest difference? And we published that. And of course, we had more than 800 stakeholders providing feedback on our materiality as we went along. And I think this is one of the most important things for all companies to do, because I think companies have limited resources, and you need to focus on the few topics where you can make the biggest impact and difference. Otherwise, you're just greenwashing. You may be, we can be the greenest company on the planet, as I said before. If you don't phase out cigarettes, you can't be sustainable as a tobacco company.
Can I ask you a somewhat provocative question? So, with SDGs, unlike the Millennium Development Goals, which are very limited in number and very, very hard in terms of their goals, right? They're sort of numerical goals. Sure. The SDGs are many, it's 165, I can't remember. It's an outrageously large number. And it might be interpreted as basically a menu from which companies can pluck a few that they're already making progress on, and then say, yes, we're going to focus on those because that basically doesn't require us to do anything. How do you avoid accusations of that sort of cynicism?
By involving stakeholders in determining your materiality. I think you cannot just, indeed, as you say, look at what you're already doing and where can we score the points. You need to really look at, where do people say you have the biggest negative impacts on society, or where can you make the biggest positive impacts? And as I said before, smoking is extremely harmful. Half of our consumers will, likely develop, let's say, illnesses as a result of using our products. How can it be more material than that? So this is what we need to focus on. And then you look at what is the agenda of the world, which is reducing or eliminating cigarettes, and how can you help to do that better? And we think our role in this context is replacing cigarettes with better alternatives.
Right. Thanks a lot. Thomas, I would like to move on to you and again ask you sort of from your perspective as an investor on the sort of attention, whether attention has indeed shifted from the E to the S among the investor class in the past 6 months, and if you're seeing that as something which is going to persist, or whether you expect it to maybe move back to E when the pandemic is behind us.
Thank you very much, and good morning. I'm tempted to give you a sort of a quick answer, which is, and forgive me for that, why don't we start with Rachel? The S is important. We need equity and gender equality. And we are 3 white male and 1 lady. And I'd like to have maybe Rachel first, if you don't mind. And I'll be very happy to answer your question right after. Apologies.
I was leaving the best for last, but I mean, we can
That's another way to think about it, yeah.
Well, I mean, you put me on the spot, so I will now go to Rachel in that case. Rachel, I would ask you a question about, sort of following on that same broad theme about the E versus the S. So, CBRE, big developer, lots of corporate clients, making spaces for people to work. Now, obviously, work is changing. Work is definitely part of the S equation, in the S part of the equation in ESG. Have you seen from what your customers are demanding, or the way that they're changing their thinking? Have you seen a shift away from a concern with the environmental footprint towards a concern with, for instance, a long-term just health, literal health, physical health of workers? And how is a healthier office going to be a necessarily more carbon intensive one? Is there a trade-off there that you're seeing?
There is, I suppose, a little bit of a trade-off. I think over the past 30 or 20 years, the property sector has got a lot better at, they started with environmental sustainability. They've got a lot better at developing and designing low energy buildings or even carbon neutral buildings. And there's a lot of focus on how those building systems are designed and made to be energy efficient. And then you've got renewables on top of that as well. I don't think social and wellness is instead of, it's as well as. Property developers are now starting to look at wellness within office spaces and workplaces. They've been looking at that for maybe the past 5 or so years, and I think there's an even bigger focus on it now with COVID and how that might impact workers. But I think we don't just look at commercial office space. I think there's a bigger question around social sustainability for workplaces and homes. I think with COVID, as we've seen people working from home more, we're starting to sort of question, are those houses and homes suitable for working from home as well? So I think there's a sort of, we're looking at both. I think energy efficiency and environmental sustainability is something that property's been working on for a while. And social sustainability and wellness is now as well as on top of that.
So it's interesting. I would like to follow up on that a little bit, because I've been working from home for the past 6 months, I would have thought, for instance, that that was obviously the summer months, and in Britain it's never. I mean, it was pretty hot this summer, but it's not typically hot enough to warrant having an air conditioner. So in some places, I was actually probably using much less energy than I would be, per person going to the office. In many places, the fact that people are working from home might actually mean that the energy efficiencies that you have in a well insulated, energy efficient office are going to be lost. So the wellness, in other words, many people like working from home. Not everyone, but many people do like working from home. Office workers, obviously. I mean, those in the fortunate professions who are able to work from home. So there does seem to be a bit of a trade-off. And are you seeing customers and homeowners thinking about it in those terms? And what are you telling them? I mean, obviously, one thing you could say is that, for instance, the fact that many people are working from home, even if they're using a little bit more energy at home, they're not commuting to work, so the transport footprint is a bit lower than it would otherwise have been. On the other hand, in our office in London at the moment, we have maybe a dozen or a few dozen people coming in, whereas normally it would be 200. So the footprint per person in that office has massively shot up. So, do you have sort of any specific answers to those questions?
I don't, well, I know that we certainly haven't, and I'm not sure if anyone's looked at yet. I guess the sort of overall carbon balance of people moving from offices to working from home. I know that across the office sector and the residential sector, there's encouragement from government, from the EU and the Irish government to make both of those more energy efficient. And I think the commute in between, I've heard anecdotally in the office that some of the Dublin bike sellers have sold out of bikes, and it's actually really hard to get hold of a bicycle at the moment. So there's a huge increase in people cycling to work when they can, I think, to avoid public transport. So I think, I guess the thing about homes is people tend to stay in them for sort of 7 to 10 years. They've kind of got what they've got. So I know the Irish government and even some of the Irish banks are helping people finance and make their existing homes more energy efficient. So hopefully through the Irish winter, we can get people to be more comfortable and more use less carbon if they are working from home more. But I think what we've been seeing is not a complete move to working from home, but people using a bit of both. So I think for long-term sustainability, we need to look at the energy efficiency of workplaces and housing.
So, and one last follow-up question on that is, obviously, investments in energy efficiency are investments, and they shouldn't be seen as a cost. They should really be seen as an investment. There is a return on it. But at the moment, a lot of companies are a bit strapped for cash, and a lot of homeowners too are strapped for cash.
Yeah.
So is this the time to really? Are you seeing an increase in these sort of investments, or a decrease in these sort of investments in the past 6 months, and maybe sort of looking forward for the next few months? Are you seeing a trend? Are people using this as an opportunity to invest, or are you seeing people hoard cash for the? Well, I mean, we're in the middle of a thunderstorm, so I wouldn't say for a rainy day, but just saving for things which appear to be bigger priorities at the moment.
In terms of the commercial sector, there definitely is a huge interest in energy efficiency and developing and upgrading existing buildings to be more energy efficient. There's just a business case for that. Investors are looking for it, occupants are looking for it. So that's kind of still sort of as it was before COVID. I think with individual householders, that's more complicated. It depends on their individual situation. But I've got a background. I worked in Australia for a while. I think compared to that, in Ireland, there's energy efficiency makes homes more comfortable as well. So I think there's an added incentive for energy efficiency in homes in Ireland compared to Australia. But I don't know if you can sort of draw trends on individual householders at the moment. It's a bit too soon to tell. But there's definitely government and financial support for it.
Right. Well, back to white males, Thomas. Can I just sort of ask the question that I did before? In other words, from your vantage point as an investor, are you seeing a shift away from E and towards S in ESG considerations?
We've seen definitely an increase in focus around S. Historically, S was a little difficult to grab, and a lot of the attention was on E. As you said, Davos and all the sort of climate research were really fueling the focus on the capabilities. And S became definitely a key determinant during the COVID crisis, to the point that we published research when we looked at the performance of various portfolios to see what drove the performance during the COVID research of the COVID correction of some ESG-oriented portfolios. And to our surprise, it was a lot connected to S. And as we dug into it, we found out that it was related to employment practices, relationships with clients. So how do you keep your revenue flowing during a crisis within a sector, comparing those which perform well versus those which did not perform well from a stock price standpoint? It became clear that those who were having better relationships with suppliers and clients and also had better employment rules and approaches in terms of not laying off all their workforce because the environment was difficult, we found that these companies outperformed. So a more loyal workforce, more loyal customers, and it connects to the context, the concept of license to operate, right? The brand and the perception of your company by a community at large. So That was not something we were expecting to see so quickly. That was not something we were actually looking for. It just came to us through our research, which we've published. So definitely S
Can I
came up.
just stop you for a second? Can I I want
Sure.
to follow up on that. How do you control for the fact that companies which happen to be doing rather well out of the pandemic can afford to maintain better a better rapport with their customers, with their suppliers, and treat their workers better, right? Companies which have seen their business balloon, like online commerce, for instance. You can they basically they could afford to be good to their workers, to keep them on. They needed them. They needed more of them often. They could afford to keep paying their suppliers. How do you disentangle that? How do you control for that eventuality? That it's not that it isn't that companies were returned more money to investors because they were socially minded, but they were socially minded because they could afford to return money to investors.
No, I understand your point. I think the main technical way we control for this is by doing this analysis on a sector by sector basis. So within a sector, so if you take the tech companies and the Zooms and all the rest, yes, you compare them within themselves, and you compare, let's say, utilities or transportation companies like airlines, etc., which really suffered within themselves. So that's the technical approach to how we do this research to come to our conclusions. Because a lot of people were skeptical, saying, not only on the S, but on other dimensions, saying, yes, you claim ESG portfolios perform better and actually were a bit more resilient, protective during the crisis. But of course, if you didn't invest in oil or energy in the first place because you kind of discarded that partially out of your portfolio, of course you're going to do better. But that wasn't the case. Most of the ESG portfolios are actually sector neutral, and it was controlled for these sort of distortions. So that is a very important, easy criticism, but also very easy to analyze in the research. So that's the first element. And I think the second element around the S is there's been a surge, as we all know, in government funding, central bank intervening. And so that is a reflection in a way of solidarity. You can be cynical and also look at, okay, it's to protect the economy as a whole. But at the end of the day, it's to protect jobs, making sure people can have a livelihood. And that to us is massively changing asset valuations as investors. So the S is becoming important also through the interest rate policies that we see across the world. That being said, so these two factors are important as dimensions. That being said, it's pretty clear to us that the E remains the #1 focus of investors and of policymakers, of regulations, and even of society at large, right? If you see demonstrations, yes, we see some against masks in some big cities, but most of the demonstrations are around the climate. So I think it's a delicate balance. And at the moment, what we see as two big themes for investors is, on one hand, and a lot for institutional investors mainly, climate orientation, thinking much more rigorously about 2050 net zero being 1.5 degrees above pre-industrial levels. That is attracting a ton of research, a ton of design for portfolios to actually be able to connect 2050 pathways to portfolios on one hand. And the other side is sustainable development goals, as you were mentioning earlier. That seems to become a language for private investors in particular, to really understand what they are putting their money to. And even though the sustainable development goals were designed for country level objectives, so very hard to connect to a portfolio, the 169 targets that are underlying them are targets that can be connected to ESG metrics. And that's the kind of research we're doing to really progressively analyze portfolios in light of this. And the important question you raised earlier is, you can't just pick and choose. You cannot say, I'm supporting SDG number 5, whilst at the same time you're harming SDG number 8. So it's really about a net effect. It's about the concept that the EU is developing of do no harm, that are progressively getting embedded in our portfolio designs. So, and I think the SDGs is in a way the layman's way of talking about the S in ESG. A lot of it.
So can I ask? So, you know, ESG, one of the problems, one of the sort of criticisms, or maybe it's not a criticism, but sort of one of the challenges for ESG investing is coming up with the right accounting standard and metrics. There's a proliferation of accounting standards and metrics for ESG. You know, some of them lead to somewhat sort of counterintuitive results, such as, you know, something an oil and gas company being scoring pretty high because it's moving away from coal to oil, or from coal to gas. Still a brown, if not an entirely dirty fuel. But there is a proliferation of standards. Do you see investors coalescing around a certain set of standards, or maybe just a handful of sets of standards that are becoming, you know, best practice? And if not, when do you expect that to happen?
Very, very important point related to all the data behind ESG and how it's used and the quality of it and the analytics behind them. So I'd say two parts to your question. One is about really the standards, like SASB, TCFD, GRI. These are organizations that are putting in place and proposing ways for companies to disclose. On the other hand, I think you referred to scoring systems where maybe an energy company would score high and a greener business would score not as high. These are more data providers like the index providers, or a number. There's a flurry, as you say, of ESG data providers and impact data providers. So there are parts of answers for both. So first, for the accounting standards, the proper one, what is very difficult to manage for the world is when there's fragmentation, different points of views of how we should report. We've seen over the years, the accounting standards, not the sustainable ones, but the traditional ones, have progressively converged to an international standard. In various parts of the world, still not uniform, but at least manageable for companies to report and then make some equivalence. The same is expected for sustainability standards, but we're at the start of the journey, so everyone's kind of innovating in their own part of the world. What's very encouraging is the recent, in June, combination of all these organizations to aim for something that's combined, right? So where companies will be able to not have to choose between one standard or the other, or have to report on all these standards. So that's very encouraging to us, that the sort of rivalry, for example, between GRI and TCFD and SASB, sorry, came to an end. Both organizations talk to each other and are now working together. This is fantastic. I think this is what we support. There's also a global tension between more Anglo-Saxon and European standards coming together. Again, they're talking to each other. That's necessary. We find already that using these standards is extremely effective in terms of encouraging companies to disclose. So TCFD definitely has helped the financial industry to be able to analyze these companies, because we can want and to change portfolio management in the direction of sustainability. If there's no data, we can't do much. Then when you look at scoring systems that various index providers bring to us and non-index providers, you're right. The criticism that's usually made is company A, scoring company A and company B end up with contradicting messages, because the aggregate scoring they provide don't add up, contradict each other. What's important for asset managers, and that's also what our clients are putting onto us, is they don't want us to just blindly use the aggregate scores. They want us to do our own research, use the raw data, and understand why these differences exist. And we actually can justify why a provider A and provider B come to different results. It's just because they've aggregated data differently and they are showing something different. If we use the core information, and that's what we've built, and many sources of data, then we can really have insights to manage portfolios. So I think what's important is the availability of data on climate, on social issues, so and at a raw level, so that asset managers can use them at raw level and then do their own analytics.
Thank you. Aris, I wanted to ask you, sort of from your perch as an academic observing this world, whether you're seeing something similar to Thomas. In other words, that there is some form of a convergence on the standards, but still a little bit more of a way to go on the specific indexes and metrics, and you know how you see the prospects for having something relatively uniform for most people to agree on in the way that we have, you know, the GAAP accounting standards for finances.
Thank you. So I you know, I want to reframe the question a little bit and to say that Thomas has made a very clear case, and the announcement this month or last month about all the different providers, CDP and SASP and GRI and so on coming together, that's a great step in the right direction. But I think in a way we're a little bit past that conversation. Not that it isn't important, but it's a mechanism. I guess that the reality of things, I cannot see a rationale where a company, and I'm not talking about from an investor perspective here, but from a business perspective, I cannot see any sort of reason why a company that is invested in the future, has a long-term view of what it wants to create, how it creates value, can afford to ignore the environmental, social, and governance considerations. All the evidence around us at the moment, whether environmental, the impact of climate change, degradation of natural ecosystems, the growing polarization and side effects of inequality, you know, they create very real commercial, financial, economic, reputational, ideological, personal, generational. There's a million business cases that a company can make. So we see many organizations, particularly this year, but over the last kind of decade or so, that have set very ambitious policies, net positive to 2030 to 2040. And we've had a flurry of those companies from every single sector, technology, retail. We've had, you know, the Unilevers have been followed by the Danones, the IKEAs, Google and Microsoft, and many, many examples who have not been hampered by the lack of convergence of those standards, that have gone ahead and put some very, very ambitious goals. So I would not, you know, I cannot take the lack of convergence of standardization, that we're not there yet, as any reason why companies could not and should not take ambitious action to address not just their own footprint, but their change in role in society and what is expected of them. It's no longer enough for an organization to say, you know, we emit, we'll try to minimize our footprint. You know, who cares if you try to minimize your footprint only? What COVID has shown us is how connected we are and how interdependent we are. So everybody, all those forward-looking organizations, if they want to play a role in this new sustainable economy, then they have to start looking at how do they create solutions for problems that we experience as society as a whole, to retain that license to operate. And the other sort of, from an academic point of view, counterpoint is, whilst we often talk about the lack of clear evidence about the causality between returns and sustainability, I don't think I've ever seen any evidence that says a company that has invested in sustainability has not done well financially. I haven't seen anything that says, you know, we are investing, we are taking action, we are investing, we're becoming a better company, managing our business and our risk well, and suddenly, you know, our markets are abandoning us. So
well,
I think
BP is one example. Just after BP announced its very ambitious environmental plans, its share price collapsed. I think it's lowest it has been in a couple of decades. Thomas can correct me if I'm wrong, but it does seem that it's not always necessarily a one-way bet, which isn't to say that BP is doing the wrong thing. On the contrary, it could well be doing in the long run, it could be doing absolutely the right thing. I think becoming a new type of energy major is a long-term bet that could pay off. It clearly didn't pay off in the short term.
Yes, and if we look at the short term, then I don't know. You know, an announcement is very different to performance. and I'm referring to performance. If somebody says we're going to do this and we're going to do that, and markets react in a specific way, that's fine. But I know of no company that has invested seriously in sustainability and has made its business model, the way it creates value and how it distributes it to the various stakeholders, more inclusive, more circular, more net zero carbon, more nature positive, and has come back after a couple of years later and said, you know, sorry, no, it didn't work. You know, I'm very open to suggestions and evidence that kind of shows that. But I think the bigger point that I want to make is that there's dozens, now hundreds of companies that are committing, putting some very ambitious plans forward for sustainability, whether that's climate, nature, and we've seen a lot of action on business and nature recently, or increasingly in inequality and economic inequality, which is becoming better understood, but still we have a long way to go to make the link between the business role in inequality, and we do a lot of work in CSL on that. But I think there's good things that need to happen. Convergence of standards and metrics is definitely one of them, but that should not hamper ambitious business action at all at this stage where we are.
So let me finish with a quick question. We only have about a minute and a half to go, to Rachel and Huub about ambitious business action. So Aris mentioned, you know, 1 million business cases. Could you give each of you, could you give me a 30-second, your number one business case for your company, specifically for CBRE and for Philip Morris International, of sustainability? What's the maybe not the lowest hanging fruit, but what's the best business case for you, Rachel, and for you, Huub? Rachel, let's start with you.
I think one of the sort of biggest, also the most exciting trends I've seen in the property sector in the past couple of years is, I think different companies are really starting to collaborate, and I think the World Green Building Councils and the different country Green Building Councils have really helped pull companies together, is that they are setting ambitious targets to be carbon neutral by 2030 or 2040. And it's working really well as an industry because it's helping build capacity within those industries, setting up the supply chains to deliver those solutions. And rather than competing and trying to do one up, there's been a real sense of collaboration and moving together as an industry rather than trying to compete with each other. And I think that's been really successful and helped sort of smaller companies sort of be pulled up by the larger ones. I think that's been a really big success, and I hope to see sort of more examples of that in the future, maybe around social sustainability or other issues.
So industry coordination, certainly one good way forward. And Huub, from you?
Well, I think our business case lies all on the smoke-free vision. I mean, 1.1 billion people smoke cigarettes today, extremely harmful. We have a better alternative, other companies as well. We think in 10 to 15 years, the world can be without cigarettes. And that's not just good for people, it's also good for business ultimately, because the new products are also profitable. We are ahead of the competition and gaining market share. And honestly, I think if we would just have a slogan and no metrics to follow how we are moving, people would not trust us. And also, they wouldn't trust us unless it would make business sense, and it does. So I think, you know, improving your products for the health of the consumers in our case, that's a very strong business case. Otherwise, stakeholders and shareholders and the board would never approve it.
Well, wonderful. That's a very positive note in a way to end on. I'd like to thank each and every one of you. It was a very interesting conversation. I hope that everyone listening found it enlightening as well. I thank the panel, and normally we would have a huge round of applause. We can possibly hear it virtually now in our heads. I'm sure the panel deserve it.